Hi, everyone, and welcome back to Wade into Wealth. It is really good to not be wearing LuLaRoe pants this week.
Yes.
Although they were comfortable and buttery soft, I think certainly applied.
I won't ever wear them again.
yeah.
I mean, you can. You're free to if you would like, but
No, I'm good. I'm good. Once was enough.
I've given them back to Mom. They're hers to have and to keep.
Once was enough. So
Yep.
Good to have that behind us and in the past. And we're happy to be back with you. Again, just a reminder that we are now on YouTube as well. So if you would prefer a video aspect or to be staring at our ugly mugs, you can find us on YouTube by searching for Wade into Wealth. We'd love it if you could subscribe, and wherever you're listening or taking us in, we're happy to have you with us. So thank you for that. This week, we are talking about debt, and specifically the debt ceiling, and something that has been in the news lately.
It's going to continue to be.
Yeah, and it's really important, but it's one of those topics I think that we hear but don't really understand. What does it mean? How does it impact? How could it potentially impact me directly? And why are both branches of Congress, or the Democrats and Republicans, why everyone is just blaming the other party for what's happening right now? So
I mean,
why don't we?
Don't they always do that?
They always do. So why don't we start, Eth, with an explainer of what the debt ceiling is, and then we'll go into how it'll impact the potential impact and so on.
So our government has a lot of expenses. We have Social Security, paying for our military personnel, Medicare, Medicaid. The United States government has a lot of expenses.
Federal employee salaries.
Right. Taxes help pay for a lot of those, but they don't cover all of them. And so the government issues debt. Now, debt is, we think of it as a bond where they'll borrow money from, it could be an individual investor, it could be an institution. They'll borrow money, and with the expectation that they will pay interest and the money that they borrowed back at a certain date in the future.
Borrowing of money, meaning they issue treasury bonds.
Correct. In 1939, Congress passed a law that limited how much debt the government can take on. This limit is known as the debt ceiling, or even the debt limit. Now, since then, the government has raised or suspended the debt ceiling almost 100 times.
Since the end of World War II, almost 100 times.
I think it's 98 to be exact, but just under 100. In 2019, Congress even went as far to just suspend the debt ceiling, meaning they had a period of time where they weren't going to bump up against it. They were just ignoring it. And
no limit.
I think a lot of the politicians will look and say, we're going to do this, 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 and this. And then when it comes time to pay for it, they look at it and say, oh, yeah, well, we have this debt limit. So we're going to take it down to the 11th hour and create a lot of anxiety along the way, because it's always the person across the aisle. It's certainly their fault.
It absolutely is. So let's simplify this a bit. The debt ceiling, think of it like a credit card that you or I might have, in that it has a specific amount that you are allowed to borrow. So you want to go buy new furniture, or you want to make a new purchase, whatever it is, you can go do it. Now, you don't have to pay for it now. You do have to pay for it over time and with an interest rate attached to it. And by increasing the debt ceiling, that would be like you or I going to our credit card issuer, going to Visa or MasterCard or American Express, and asking them for an increase in our available credit. So you've got a $10,000 credit limit and saying, we'd like it to go to $12,000. This is the same thing, but now we're talking billions and trillions of dollars.
Yeah, and in fairness, when you go and ask your credit card company to increase your credit limit, unless you have a change in your assets, or you can show them that you have more income coming in, they'd be unlikely to increase that for you. And so circumstances are relatively similar. That's a great analogy. But then becomes the question of, what if they don't increase the debt ceiling? Because, as I had mentioned, in 2019, they just suspended it. That suspension ended in July of this year, so a couple months ago. The Secretary of Treasury, Janet Yellen, has been using emergency measures to keep it going, and now they anticipate that on October 18th, without an increase in the debt ceiling or the debt limit, that our government is likely to reach their capacity for continuing to be able to fund a lot of their operations. Now, what's important is that the 18th it's not a date that's set in stone. It's a best guess. There's also long historical examples of the Treasury Secretary putting a date that perhaps is a little sooner than what the true date is. It's kind of like
sure.
someone who's always late for dinner, and you tell them that dinner starts an hour before it actually does, so that they truly show up on time. But in this case, I don't know that it's something that's overwhelmingly wise to play a game of chicken with this date, because in the event that those two cars crash, I think that we would be likely to see a very significant disruption in not just the United States economy, but the global economy and stock markets throughout the world.
Yeah, so let's talk about this in two layers. One, what the potential impact would be, and we can look back through history to see what that impact has been. And then how would it impact you if you're listening to this and thinking, okay, well, that all sounds great, but what does it mean for me? So from a larger level, okay, we hit the debt ceiling and there's nothing there left to use. So almost immediately what would happen is the price of Treasury bonds, United States government Treasury bonds, is going to drop.
Well, right, and that's because Treasury securities from the United States government are considered to be some of the safest investments for international investment. And if all of a sudden the government can't pay on those, they're now a much riskier investment that's out there.
So very likely that we would see a drop in the credit rating of the United States.
Which compare that to
credit score.
Credit score.
Your
yes,
credit
thank you.
Score going down. Your credit score takes a hit because you've got too much debt. Okay,
and why does it happen? Because you don't pay your bills on time.
You're not
so
paying
if
your
the government
bills.
doesn't pay their bills on time, it's only natural that their credit rating would fall as a result of that.
And you don't have enough available credit. So there's that as well. So that's one thing. So price of bonds is falling. There is an inverse relationship between the price of bonds and interest rates. So price of bonds falls, interest rates increases. Now, it's important to realize that most interest rates, be it a mortgage, auto loan, home equity loan, credit cards, are in some way, shape, or form tied to Treasury bonds and the interest that they pay. So if the 10-year U.S. Treasury has increased its interest rate, mortgage, auto loans, home equity loans,
business
credit
loans,
cards, anything, cost of borrowing is going up quickly. So as to how's this going to impact you? Do you have student loans, variable rate student loans? That rate's going up.
Home equity lines of credit.
Credit cards. Those are all going up. If you are going to apply for a mortgage, it's going up.
Right.
If you're looking to refinance, it may not be as good of a deal all of a sudden as it was a couple weeks prior because interest rates are going to go up. So that's one side of it. Stock market, likely to see significant volatility.
Yeah, I mean, we saw this happen back in 2011, which was really the last time that Congress really took it down to the wire. It resulted in, while the U.S. government did not default, and they have not yet to date ever, they did end up, Standard & Poor's, a ratings agency, did lower the United States credit rating. They took it down from its perfect rating. Think of that as you as an individual miss your payments, your credit score is going down. That happened with the United States. That also created a pretty significant amount of volatility in the stock market up until that point, because we have it now. I think there's more attention that's starting to be paid to it, but there's a lot of anxiety around this, that if the most financially stable economy and country in the world were to default on some of their debt payments that they have, that would create a significant amount of uncertainty. And uncertainty equals volatility.
Yeah, markets don't like uncertainty.
No.
That is the number one cause of the market dropping is uncertainty.
Yeah, absolutely.
And so that would certainly be felt. And, we make the joke often. We joke with clients that, we got the United States has the worst economy in the world.
Yeah.
Except for all the others.
Right.
And so when you're looking at this from that perspective and saying, well, even the U.S. economy is getting a downgrade, think of it as, even though you may not take your credit to the max, you may not spend the full amount of available credit you have on a credit card, as your balance gets higher and higher, your credit rating will decline because the ratings agencies are looking and saying, all right, well, there is more risk associated with you right now because of the balance that you are carrying. And so not unreasonable. So there's a lot of things that could happen if we get to a point where this debt ceiling is reached. Also conceivably benefits would stop.
Yeah, I mean, that's, I think, a really important thing for us to discuss.
It's huge. I mean, we sometimes get lost in, well, what's it mean for the stock market and the economy? All right.
I mean, a lot of our clients are getting Social Security.
Right.
They're on Medicare. If you're a military personnel, it's entirely feasible that if we breach the debt ceiling and our treasury, the reserves and coffers dry up, that your Social Security payment could be delayed, possibly missed. And that's a real thing. I think that's also probably a big reason why Congress has never missed the payments on this.
They've never missed a Social Security payment going back to 1935 when it started. Right.
And I highly doubt that this batch of politicians want to be the first. But, again, that date of October 18th, I mean, could it happen before that? Sure. Could it happen after that? Yes. It's not set in stone. I don't think this is something that our politicians should really take down to the 11th wire. But
no. And nobody
I'm sure
wants
that
it,
will happen.
Nobody wants it on their record or
No.
that it to happen on their watch that Social Security defaulted on payments, that veterans benefits were halted, that federal employees were unable to be paid, that the military was not able to be paid, that the stock market dropped significantly in value, that the credit rating of the United States was dropped. I mean, there's all these
again.
downgraded.
They don't want that.
There's all these reasons, but we have seen this play out time and time again. I don't care what your political views are if you're watching or listening. I really don't care.
It doesn't matter to the equation.
I've had enough of it, and I'm tired of it. But what we are seeing is that both sides of Congress are just using this as an opportunity to bash the other. This is your fault. The Democrats are saying it's the Republicans' fault, and the Republicans, it's the Democrats' fault. So that's what's happening right now. This is a chance to posture. It's a chance to throw blame towards the other side. The reality is neither side wants this to happen, and it would be significantly bad for it to happen.
Yeah, and I think, from our perspective, is it likely that we blow past the debt ceiling and have all this happen? I think we would probably label that as an unlikely event.
Yeah.
But that doesn't mean that the chances of that happening are zero.
Right.
And it doesn't mean that they haven't had that happen in the past and really take it down to where they started to get, everyone started to sweat a little bit. And I think we would all prefer to not get to the perspiration stage of the debt limit and the debt ceiling this time, because it's not something that should probably be messed with.
I get to the perspiration stage enough on my own. I prefer not to have help from other external stimuli. And I don't want to get into, there's no prediction coming here as to what's going to happen because we don't know. And instead of trying to make predictions, I think it's important to observe history and behaviors and see what's happened, but also to be respectful of the fact that, it's very easy to say, well, it never happened until it happens.
Oh,
right?
yeah.
It's very easy to say that, and so
everyone's got a clean driving record until they get a ticket.
Right. It's absolutely right. So, I don't know how this plays out. We don't. So what do you do then, though? Okay, so there's the question. What do we do? Because you two geniuses are saying, hey, all this bad stuff could happen. We don't think it will, but we don't know. So what do you do?
Well, obviously, the first step is panic.
Right.
No,
that's a joke.
We're kidding. Don't panic. The reality is, remind yourself of why you're investing in the first place. Chances are you're not investing for next week.
Right.
You're not investing for 6 months from now if you're owning stocks and equity-like investments. You're investing for the next 5, 10, 15, 20, 30, 40 years. And there's always a reason not to invest. There's always a reason of uncertainty that will create volatility for you. Stick to your plan. If you don't have a plan, make a plan. Work with someone that you trust to get a plan, because it's important that you don't panic in these times of uncertainty. And what you never want to do is allow short-term volatility to jeopardize your long-term goals.
Well said. Very well said.
Well, thank you.
Kudos to you, sir.
Yeah, thank you.
So let me give you let's devil's advocate of a sort, but not really. Let's say, so we're coming off of September. Now, I don't put a ton of weight into the fact that people say, oh, September's coming. It's going to be a bad month for the market.
Sure.
But it just does so happen that
it was a challenging
this past
month
September
for the
we're
markets,
coming off was a challenging month. It was the worst in terms of performance, going all the way back to March of 2020. And I was talking to a client this morning, and they said, oh, what happened in March of 2020? How quickly we
Pandemic.
forget that a pandemic came, and we had a good laugh over that. Yeah, said, that was when COVID started and became a thing, and we went into lockdowns, et cetera, et cetera. So it was a bad month. When we really stress a lot of the time not trying to time the market. However, when you talk about sometimes you can be somewhat opportunistic. What is something else you can do? Some people who may be looking, you want to buy something low. Could there be more volatility in the markets ahead? There may be. Yeah. There may very well be. We're coming off a period of time where, the markets have struggled for a bit. If you are someone who is a market timer, so to speak, maybe not the worst time to be looking at some quality investments that are cheaper.
Yes,
all of a sudden.
And we're not market timers.
That are, but there are investments that are 5, 6, 7, 10% cheaper than they were a few months ago that I think you and I would both say, hey, that's a good company. That's a quality investment.
Yeah, and I think you go into that with the idea of that's a long-term investment.
Right.
You're not buying it because it's down 5 or 10% for it to get back to where, the hope that it gets back to where it was, and then you sell it. If you're going into it with the idea that this is a good investment, I believe in this, it makes sense to me, and I'm going to get into it for the long term. I can't remember who it was. For some reason, I want to say it was John Templeton from Franklin Templeton, but I think I could be wrong, who said that the best time to invest is when you have the money to invest.
Yeah, absolutely.
And that's absolutely. It's not about timing. It's about quality investments with time. It's not about timing the market. It's about time spent in the market. Get good stuff. Give it time. The fact that something is trading at a high now probably was also trading at a high 5 years ago. And 5 years from now, very well could be trading at another new high. So if you believe in it, if you may, and there's certainly some opportunities out there now for good quality investments that are off of their recent highs. But please go into it with the idea of it being a long-term investment. If you're not going into it with that idea, take a step back and remind yourself that not even Warren Buffett, someone who's considered to be one of the most successful investors in history, can time the market. Please don't try.
No, don't try. It's a good point. So, yeah, some things to consider. So we've got, and this is the thing, we're recording this. We don't know, we don't know what's going to happen with the debt ceiling.
Right.
We'll certainly revisit, but I think it's important to provide context to what it actually is and how it could actually impact you. You don't get that in 30 seconds of a story on the news or or something you see on Twitter. Well, debt ceiling about to be reached. What does that mean? There's a lot of meaning behind it. It's something that's very, very important, and I think we can understand it easily with some context, and that's what we wanted to provide today.
And I believe we're very likely to see much more of this in the news in the coming weeks.
Yeah, absolutely.
Likely to say that if you're receiving Social Security, your benefits may not be paid to you next month if this happens because the media breeds panic. That's only natural.
That's likely to be said, is what you're saying. That you're likely to see that. There's likely to be headlines, why you may not be receiving Social Security next month. I can already see that CNBC headline.
Oh, yeah, 100%.
Out there.
Yeah.
Headlines are created to get people to click, read, and subscribe.
Yep.
But it's important to have context.
Which reminds me, if you find value in this, please click on subscribe just below the video or on the podcast.
Or leave a review. We'd love to hear what your thoughts are, and we do appreciate you being with us. Any final thoughts?
Don't panic. There's always a reason not to invest. Focus on the long term. Don't allow the short term to jeopardize your bigger picture goals.
And with that, we sign off for this week. Thanks for joining us again on Wade into Wealth.